làm bảo vệ lên nóng cửa đổ đi xuống. Rồi tới lần
Okay. Explain me where the ATM machine is and on the campus?
You know, as the bridge over to, you know, I think there's a three bridge, right? Three parallel bridge, right? So the one that
brings you to the building, to the main entrance.
yeah, to the main entrance.
It's in the building?
It's a bit outside the building. It's not totally out the gate yet. But once you cross the bridge, you pass the security guard, then you can see there's, you know, kind of like a small shed. Then there's a 2 ATM machine.
Okay, so it's on the side where the river is.
Yes.
And not where the street is.
Yeah.
Okay.
But
so from the bridge,
later I can show you much easier. Okay. It's just like 3 minutes walking from after class.
Yeah. And from the bridge I should actually see it already.
Yeah.
Yeah, no problem. I will find it. Okay, students, welcome back. To be honest, we are a little bit behind time. I expected to be much quicker. So we have only 3 sessions left, and we will basically finish the M&A section, and then afterwards do not do corporate governance as originally planned, but jump to capital structure, because these are the textbook chapters that are also, that is basically the basics of corporate finance. M&A is a bit more advanced, so this is not what everybody would expect from an introduction course into corporate finance. And hopefully we'll also get some of the corporate governance stuff, but then of course there was some point of time when I could hand over to Jan. And by the way, the exam, of course, when you prepare for the exam, some of the chapters where we mainly use the slides from the chapters, the original textbook slides. These chapters are best prepared really by reading the textbook and basically looking at the end of chapter questions. And the end of chapter, the exercise sessions that I'm going to do is mainly based on these end of chapter questions. There are some variations of these types of questions, and they are very, very relevant for the exam. And then there is this part on M&A, where you will see that the textbook also has something, but it's much less steps. And there the slides basically give you an additional kind of input, and you should also prepare them. And then of course this corporate valuation, with multiples and how investment bankers do it. This was something that we did on top of the usual stuff. And of course, maybe there will also be a question in the final exam. But of course, I don't expect you to read a textbook from this. But of course, I would expect you to have spent your time on the exercise, and spend your time on the slides, and basically get this input from this. Okay, so let's think a little bit on the economic effects of takeovers. This is our last section in the M&A section, and of course, the key question is already raised in the beginning. Why? Well, is it creating overall gains? Is takeover actually good economic activity or bad? Yeah? Some people basically just look at the shareholder returns and say, yeah, when the share prices go up as a result of M&A, yeah, then it is good and the economic effects must be positive. But of course, there could be other people. Yeah? Shareholders gain, but other people lose. Yeah? So let's look a little bit at this. Yeah? And combine with this question, because the question, do we have too many or too few takeovers? Yeah? You saw these extremely dangerous defense weapons, yeah, like poison pills or golden parachutes. Yeah? And of course, many people think if we allow too much defense, yeah, we will see too few value-generating takeover activity, yeah? and the government actually should stimulate the whole thing. Yeah? But some people actually say it cannot be that the brightest people all work for takeovers and M&A instead of producing cars or telecom companies. If there is too much absorption by Wall Street of good talent, then it may be bad. Yeah. And as we saw in the Time Warner case, yeah, takeovers may be basically the result of managers pursuing their own interest. Yeah. The Time Warner merger was clearly not motivated by generating shareholder value. It was motivated by preventing being taken over. Yeah, so maybe M&A is just in order to become big, yeah, in order to prevent being taken over. Yeah, and then of course we would have a very more negative stance on this. Yeah, so many people that are pessimistic about the economic effects basically say managers are empire builders, and if managers have too much cash, if they run for corporations like Gerdau Benz that are extremely profitable, maybe they just misuse the shareholders' money for M&A. So takeovers can be the result of agency problems. Basically saying that they are the result of misaligned incentives. And there were many empirical studies. This slide set is very, very short on this. Basically, there are tons of studies. And there was a lot of evidence that managers have interest basically plays a big role, as you saw in the Time Warner case. It was clearly driven by, and that such acquisitions generate no or even negative returns to acquiring shareholders. So if you are the shareholder of Time, it is no surprise to see the share price going down. So we have a significant amount of takeover activity that seems to be harmful, and shareholders actually should try to prevent this. And of course they can prevent this. They can simply replace managers that do this. And just one example, when managers of the acquiring firm own large shareholders, so if they would suffer themselves from a declining share price, then bidder returns are much higher. So look at the Time example, where at the day of the announcement, the share price went down 10%, roughly. This is less likely to happen if the manager owns the shares, because then he basically gets penalized himself. So the evidence basically looks at whether incentives drive the result. And if you find, whenever the manager owns a large fraction of the shares, this is less likely to observe. But of course, you conclude that incentivizing managers with share ownership is a good idea to prevent this high kind of value-destroying takeovers. So in the end, we are not only talking about M&A here. We are by studying M&A, you see what kind of instruments, for example, forcing managers to own shares in order to align the incentives of managers and shareholders, whether this is a good idea or a bad idea. And if you see, whenever these companies acquire other companies, they have a better performance of their share price. That gives us a nice idea that this really matters and is important and is helpful in order to make takeovers economically profitable or interesting. If we look at the combined value of bidding and target firm, if you think about social welfare, of course you look at the overall pie. And there is strong evidence that even if some bidding firms lose valuation, lose market cap, like the Time case, it is offset by the bidding firm. Just remember our Time Warner case is really typical. Yeah? The Time share went down, the Warner share went up, but the overall market cap went up. Now, on March 4, yeah, the two firms in total were worth more than on March 3, the two firms. Yeah, and that is rather robust thing. Yeah, so the positive combined returns basically reveal that shareholders benefit from this. Yeah, basically, there is a strong evidence that shareholders benefit largely from takeovers. Of course, we measure only from one day to the other. It's just the announcement effect. That could well be that the stock market reaction is not efficient or is not. Yeah, the stock market, of course, cannot foresee the full future. Yeah, maybe they are too optimistic. But if we look at the stock price 5 years after, basically that stock price is in fact affected by so many other sources, yeah, that it's hard to basically crystallize the takeover effect. Yeah, in the research, we usually just look at one day before and one day afterwards, and basically say this is the stock price impact of the takeover or of the merger. Yeah, but then social value basically means value not only for the shareholders, but for the whole of the society. Yeah, so let's look at who else could be affected. Yeah? And I give you 3 examples. Yeah? The corporate raider takes over a firm, shareholders are happy, yeah, they make a lot of money, yeah, but then the raider fires 10,000 workers, yeah, but these workers find work elsewhere at the same wage. Yeah? Then we would say, yeah, there are clear shareholder gains and that there were no losses for the workers. Yeah? Of course, it's maybe inconvenient, yeah, they have to search a new job, but if they find a new job in another enterprise, then we would argue that this is economically, on a social basis, beneficial. Yeah? But if they have to accept a 30% wage cut in their new job, or in case C, where they're all fired, but then the whole area basically has high unemployment, the house prices go down, the people do not only lose their job, but they also suffer from house price decreases. When they sell their house, they make a loss. And then, of course, we have what we call external effects, negative external effects on the workers, on the housing market, and so forth. And this kind of external effects, of course, should also play a role when we say, do we have enough or too much takeover activity in a country? And besides the workers, there were other people. Oops. That's not on. Okay. Let's really stick to the slides. More external, potential external effect will come up in a minute. Those people that say takeovers are good basically argue that the shareholder gains, the increase in shareholder value basically reflects performance improvements. At the market, the share price goes up because the market expects higher profitability in the future, more dividends. And then, of course, you can look at the accounting in the 5 years, for example, after the takeover, and basically what you see is conflicting evidence. It's not so easy. You see the stock prices go up, but it's hard basically to find the evidence in the accounting numbers that really the profits are going up. And that was a kind of a frustration for those people that basically argue pro takeover. But at least in the case of leveraged buyouts, and in particular those LBOs that are financed by private equity, there was clear evidence of improved operating performance. So their profit margins really go up. So this is the most dramatic case. And then some studies reporting productivity improvement on the plant level. So basically, although the shareholders' values increase, it seems to be difficult to really understand the sources. And of course, one idea is simply that the stock market is not efficient, is not basically rationally evaluating the future dividends. Maybe the people just become more optimistic. When you think about Elon Musk, whenever he sends out a Twitter, please buy this, buy that, then the crowd of stupid people basically follow him, and the Bitcoin price or whatever goes up and down, and then we would not think that this is a sustainable kind of shareholder value created. Many people say takeover is sometimes good and sometimes bad, and sometimes it is the reversal of efficient target behavior. So let's again take Time Warner. When takeovers are sometimes driven by manager self-interest, like the merger of Time and Warner, they don't want to lose their job, that's why they merge. Then of course, as a real end result, they result rather inefficient companies like Continental, a conglomerate trading at low values. That invites future takeover activity. Continental or Time Warner may then be taken over later on. And there was again, unfortunately not so much. In the beginning there was evidence, but today basically they say available evidence fails to show that the targets that become the victim had significant poor pre-bid performance. So the idea is badly managed firms that basically have no efficient cost management, produce at too high cost, or that engage in efficient M&A behavior, they merge without having synergies, without making economic sense, that these poorly performing firms are then taken over. But again, the evidence is somehow mixed, and that's why probably, that's why many of the researchers in this area basically think this looks more like a gambler's speculation, casino type of activity, rather than really creating value. There is a result of overinvestment. Basically, overinvestment means you invest too much. Managers are empire builders, and if they prefer empires, large companies, then they have a tendency to invest, although when the net present value of these investments is negative. And then, of course, when you invest too much, then you should be basically stopped. And one way of stopping is you are the victim of a takeover, and then the private equity fund who buys the company is basically stopping this. And there was actually evidence that targets are more likely to have poor acquisitions prior to the bid. There was this famous saying, bad bidders become likely targets. So if you are a bidder, like Time, you buy Warner, but this is actually a value destroying acquisition, then you are more likely to become a target. And there was actually empirical evidence for this. But there seems to be no evidence that targets who overinvest in internally developed projects after takeover. So think about Daimler-Benz or Mercedes-Benz. They have so much profits, and they invest much more in their own plants and always have the most efficient machines, the best designers and so forth. That may be also too much. But when a company like Daimler is taken over, there seems to be little evidence that they really cut down investments. In Germany, basically, we have shareholders who love to take overs, and then we have the unions to basically protect employee interests, and basically unions are strictly against takeovers, because they say after takeover, usually there was less investment, there was less work, there were people fired and losing their job, and they basically also make the claim if a company has too much debt after an LBO, a strong equity finance company all of a sudden is settled with lots of debt. This debt may prevent the company from doing big investment projects. But the evidence doesn't point in this direction. These companies do not stop investing. Yeah, so the unions are wrong, but also the idea that overinvestment is basically terminated by M&A. This also doesn't seem to be the case. Yeah, so many of the stories that people tell each other, yeah, why M&A is beneficial and why it is detrimental, empirically lacks substantial support. Yeah, so that the easy stories simply do not hold. Yeah, so overall, yeah, the evidence support of improved governance or reduction of inefficiencies is rather mixed. And basically that says, yeah, academic researchers can't tell, yeah, whether this is good or bad. Yeah, and this is puzzling compared to the event study, because all the event studies, yeah, March 3, March 4, in the Time Warner case, yeah, in all these event studies, the capital market valuation clearly goes up. Yeah, so this is good for the shareholders. Yeah, so in the end, we still don't really understand. Yeah, thousands of takeovers happen every year. Yeah, few things have been as intensively investigated and documented. There are so many PhD students who love to do research about this, but still we find it difficult to understand why the share prices actually go up and what kind of efficiency basically is cured. Yeah, of course we think, yeah, that not every corporation is well managed, yeah, and that a takeover may improve the incentive structure and the investment decisions, but there is not so much evidence on this. Yeah, and of course then there was this anti-takeover movement. Yeah, people that basically deep in their heart believe there were way too many takeovers. Yeah, and there were many negative effects of this that we also should consider before basically saying that this is value creating. And they basically say just looking at shareholder gains is a bit too short-sighted. And the idea of these people is, yeah, if you think about the four parties, yeah, two groups of shareholders, two groups of management teams, yeah, that basically sit on the negotiation table, then it is clear, yeah, that some people know more than the others. Yeah. Every management team has inside information about his own corporation, but not the other. Shareholders usually don't have any inside information. And and this all, of course, suffers from this problems of the growing beans created that we talked about on Friday. And that's a separation of ownership and control basically makes it unlikely, yeah, that whatever comes out is a good thing. So there may be other consequences than efficiency gains, and of course the Time Warner case, yeah, is the easiest case to understand this. So, and now comes this, yeah, we started 5 slides ago, yeah, that employees may be fired. Yeah, so maybe that the shareholder gains comes at the expense of employees. Yeah? Even if you argue this is non-existent or small, yeah, then still there are others. There were creditors, suppliers, and customers. And there is, sorry, it's not on here, it is the fiscal authorities. Yeah? Let's think about who could suffer. Yeah? If you take over a firm and you settle this with more debt in the LBO, then of course the debt becomes more risky. Yeah? So the debt that was existing before, suppose you start with a conservatively financed company, you take it over, and as a result, the equity will be almost zero, and instead you have new equity as a result of this LBO. Yeah? And this debt will have increased risk of bankruptcy. Yeah? This new debt, of course, also has a high risk of bankruptcy, but they will charge a high interest rate. Yeah? These debtors know what they finance, yeah? But these basically may experience a decrease in value. Yeah? And I show you just how it could look like. Yeah, there were famous examples where the bond price was like this, and then on the announcement of the LBO really dipped down significantly, yeah, maybe by 10%. Bond prices are something like in the area of 100, yeah, and then as a result of the LBO, they may go into 90, simply because the bond market anticipates a much higher probability of bankruptcy, right, as a result of the LBO. And then these losses, of course, are offsetting any shareholder gains. So it could be that takeover basically creates shareholder value gains at the expense of the bondholders. And of course the same thing with suppliers and customers. Maybe the customers will prefer if the takeover reduces competition and increases monopoly pricing powers, and then the customers ultimately pay higher prices, and then basically the shareholder gains are at the expense of customers. So the idea is it could be motivated by the expropriation of these other stakeholders, but the evidence, these are the evidence, and I think on the next page we see, we see what the empirical. There are many empirical studies who basically indeed find some losses of this kind, but they are much smaller than the shareholder gains. So the stakeholder losses, that is employees and customers and so forth, expect only a small fraction of the shareholder gains to shareholders, of the gains to shareholders. So the bottom line of this empirical literature is, yes, it exists. Yes, employees may suffer, bondholders may suffer, but empirically this is small. And I told you that this, of course, happens only if there is no material adverse chain clause or change of control clause. Once you observe this here, you will only buy bonds in the future that have this clause, and will get your money immediately back. So bondholders can easily protect themselves if they want. So if this would be a big issue, the bond contracts would change, and this, therefore, it is not really likely that this will be a big thing. So basically, the lack of finding large losers suggests, of course, that shareholders indeed create value. There was one thing that is not here on the slides, it is the tax authorities. Many takeover deals actually are called tax evasion deals or tax arbitrage transactions. You bring the headquarters of the merged company to a tax haven like Ireland or the Bahamas or the Bermudan Islands, and as a result you pay much less taxes. Then of course shareholders benefit, and the tax authority or the overall population collects the tax, and they suffer. But again, there is some evidence that this explains only part of the game. So so the evidence so far basically says there was undisputed shareholder gains, just if looking at the day before and after announcement, and there is no reason to believe that all these other stakeholders basically suffer in the same amount. They suffer even more in a much smaller amount. So but still then these people will say, but even if takeovers create value and all these negative effects are not there, they will still be rather ineffective, simply because other governance mechanisms may be much more effective and cheaper. If you believe a takeover is basically the instrument that the society has in order to fire bad managers who are empire builders or bad performing, then of course you should ask yourself, do I need to pay all the costs of a takeover in order to do this? Why not forbidding takeovers and simply asking shareholders to fire these people? Maybe they could be takeovers basically consume huge amounts of resources, And just the cost of doing this gives us the idea that we should search for something else. In Germany, for a long time, we compared the German economic model with the American or Anglo-Saxon model, and in Germany there basically were no takeovers, at least no hostile takeovers. And the research that basically tries to understand why doesn't Germany need this, the idea was that it is the banks. Here in Germany we have lots of bank loans, and these are usually from what we call a house bank. If you have one big bank that is financing a large part of your firm, then the house bank, of course, is a close monitor of your activities. The house bank would bear a lot of downside risk if there was a bankruptcy, so they have all the incentives to make sure that this company is well run, efficiently run, and not that somebody with a corporate jet who is basically wasting corporate money is exactly there. And in Germany, at least in the traditional Germany, we basically said our house bank principle, giving the bank large risk but also large powers, is basically a substitute for takeovers. The bank will monitor the firm, and if the shareholders are too dispersed and too small and don't care, but the bank will care. And the bank has enough powers basically to stop any kind of inefficient behavior. A house bank is nothing else than a substitute, another mechanism how to limit agency behavior, how to stop managers from doing bad things, and maybe this mechanism works much more smoothly and much more cost efficient. And then some people say, but even if you don't have a house bank, there were still some ex-ante effects of takeovers. Even if you believe that the takeover is positive and it creates shareholder value, but maybe the ex-ante effects are critical. For example, people may be so afraid of a takeover that they behave differently. Okay, so let's jump here. Suppose you do it well, you act in the interest of shareholders, run good, and then you face the risk of being taken over just because there is some empire builder and he wants to collect and buy well-run firms. Then basically, just in order to prevent this, you basically behave in a different kind of activity. So it may exacerbate, that means it increases the agency conflicts. I don't like this slide too much, but maybe I go to the next slide. I think this is by far the most important thing. Many investors basically, many managers basically say, you know what, myopic? Myopic basically is a behavior that only points to the short term. So if you only look for the next quarterly result and try only to optimize this, then you run the firm in a very short term or short-sighted thing. Good management should always look in the long run and do investments that hurt short-term profits but increase long-run profits. And myopic management is basically the idea that management is not basically maximizing the long-term value, but they only concentrate on the next quarterly results and then are basically very short-sighted. Now, why is this so? In the United States, we have a lot of basically discussion whether the focus on quarterly results induce managers to become too short-sighted, too short-term oriented. And One idea is, of course, if you produce bad quarterly results, suppose you have a great investment idea, it just kills your short-term profit, and you have to wait for 5 years until you see the beautiful profits, and then the share price will go down because shareholders are disappointed. But this will then bring a corporate raider on plan. He sees this undervalued corporation and then takes it over, and the manager is fired as a result of this. So if the manager is fired when he does the good thing, as a result of a takeover that happens then of course, the takeover still generates money. The company is undervalued, it's taken over, share prices go up. But overall, this is just a correction of undervaluation. And overall, this is detrimental simply because the manager is forced to concentrate on the short term. The short-termism debate is much broader. There were also people that say even if you don't have any takeovers, just the fact that managers are more likely to be fired if they produce bad results, and the fact that when they present bad results, the share price go down, and then their management stock options lose in value. If you pay on the basis of share price, if you pay with stock options, of course the managers have strong reason to focus on the short-term stock price movements. So even without takeovers, just from stock options and from short-sighted investors, you may have this kind of myopic short-term behavior. And in Germany there was quarterly results, a commonplace in the United States, in Germany, until some years ago. We mainly had the annual report. Under German accounting standards, you just have to report once a year. Very much like here also in Vietnam for all the family firms. It's only if you go to the stock market and you basically conform to international accounting principles, then you have to produce these quarterly reports. And many German firms deeply believed that basically having the duty every quarter to go to the capital market, explain the results, is basically a bad thing. Because so much attention and so much power of the management is absorbed by this, that you can't focus on long-term results anymore. So the threat of being taken over may actually induce you to do things that are not good. And here's another example. So the manager acts in the shareholder's interest, he's a good one, and he has superior information about the current firm value, because he made an investment. Think of Elon Musk, he started R&D on autonomous driving Tesla taxis. Of course, he knows much better when they should come and if they should come at all. He has been promising many things for many years and did not deliver. But suppose he really knows next year it is coming. But of course nobody believes him anymore, because he has been lying so often that nobody believes this. Then Tesla is of course undervalued. If somebody else, if a corporate raider gets to know this, he will basically seize it as a takeover possibility. And then basically here this says that the sale of the asset, the sale of the undervalued asset, may be the only possibility to prevent being taken over. So Tesla may be forced to sell this autonomous driving taxi operations, because then they can show all the secret information to the acquirer. The acquirer sees, oh yes, it is indeed true. But it's of course secret information. Then you can't share it with the public, because this is confidential information. And then you are forced to sell something, just because you don't want to prevent being taken over. This is just another example of how a takeover is actually not valued in the sector. So active takeover markets may prevent or at least reduce firms' capabilities and pursuing long-term strategies such as R&D investments that take years to really capitalize, that take years to really turn into profits, but where, but of course without this kind of R&D there is no long-term survival of these firms. Okay, so let's jump over these last 2 pages and sum up. Takeover is a fascinating world. Yeah? M&A is an activity at Wall Street and also in Frankfurt and London, where many intelligent people earn a lot of money from. It is clearly, it's sometimes like war, with tactics, with defense and attack, and it's like a criminal novel. And I think it creates or sometimes destroys an enormous amount of money. When you are in an M&A situation, you have a very interesting life. You have less hours in the night to sleep, and you make very interesting decisions. But viewed from the academic point of view, they simply think, well, why is this whole thing going on? And it all starts with the world and means notion, after the world crisis of 1929, that there were agency problems. Managers are the agents of the owners, but as an agent, they have their own interest and may do other things. And takeovers is basically an instrument or a device to basically limit these kinds of agency conflicts. That is the viewpoint of the financial research literature. By the way, if you ask practitioners, most CEOs of firms will say, that is bullshit. I have to work hard in order to serve my shareholders. My shareholders are very well informed. They know everything that I do. And whenever I spend a night in bed and sleep too long and do not work hard, they immediately push me and say, you need to do something more. And if I want to create an empire, they will say, are you stupid? Please do all the welfare or shallow value increasing takeovers. So that there was the viewpoint, of course, of managers. We are employees of our shareholders, we serve our shareholders, and we do nothing against their interest. The Time Warner case is a very nice and drastic example that this picture is not always the case. People today argue, well, but this case is 30 years old. Today the things have changed. Today the shareholders are much better informed, they are much more professional, and therefore Time Warner would not happen today anymore. And maybe they are wrong, and they are right. Many managers basically say this may have been the problem of the 80s. We may have had agency conflicts, but that's long ago. Modern technology, modern professionalism basically has ended these kinds of agency conflicts. When we merge in order to make our shareholders happy. We want to make more profits by realizing economies of scale, maybe by increasing market power, and then the prices, maybe also for paying less taxes, and so maybe the shareholder value increase basically comes with some sacrifices or negative things for other people, but in the first hand, there is no agency conflicts. We serve shareholders, and it's up to you to decide which of these views is more relevant to you. A takeover is much more than a simple transaction between two sides, a seller and an acquirer. It is at least two management teams, two shareholder groups, the banks, advisors, and all so forth involved, and therefore also in terms of game theory, just interesting to see how these parties interact and negotiate. By the way, if you're in an M&A class in Frankfurt, we also have a negotiation session in the end of the course, where basically you have to simulate how these negotiation dynamics look like. So we have this kind of financial professors who basically believe that the origin of all this is that managers pursue their own interest, and being the biggest firm, maybe one thing, having requisite consumption, maybe another thing. Is another thing. It's an ongoing debate on how to interpret really the takeover activity. These waves come and go, but since the last 20 years, actually, we're just one huge wave of takeovers. never ending. And with all these private equity firms, they're becoming more and more important. The takeover activity is clearly not going to stay, not going to go. When you think about if you think the old model was actually somebody founds a firm and then it is a family firm, it just has a own company. And he grows and at some point of time realizes he must have much more equity to grow. So he goes to the stock market, sells the firm, and then either stays to be a shareholder, then it is basically a large firm with a large shareholder, the old family, or he decides, as in the United States quite often, to sell the firm to the stock market, and then it is basically a steady, stable state, that this company has thousands of shareholders and continues to operate. And in the old textbook example, there was no change to this. If you look at today's capital markets, we basically say this is not the end of the company. Sooner or later, that company may become inefficient, maybe because of these agency conflicts, or it could simply be that the cost of being a public firm, of having all these quarterly reports, I think many people actually believe that having to deliver every quarter good results basically forces you to become inefficient. It would be good to invest more, but you can't do this long-term investment simply because you are forced by the capital market to deliver good quarterly results. And then at the next phase comes the takeover in the form of an LBO or going private. And then basically a private equity fund is the owner. And they do something that you know from Elon Musk when he bought Twitter, basically restructure the firm. So you say, a large part of the employees, please go home. Or you say, please invest more into R&D. Look at SpaceX. What is X? What is the rocket? The spaceship program of Elon Musk is Starship or something. Elon Musk is also investing in starships and in rockets that fly to the moon. And of course, this is a big investment. Elon Musk basically did there in a private company huge investments, and the public firms would not be able to do so. So private equity or private ownership may then, of course, be the right thing. Now, private equity firms usually have so if a private firm that is as a new private firm migrates to become a public firm in IPO, then migrates to be widely held firm, and then becomes PE owned, so we call this going private. Then after 7 years, this private equity fund usually is forced to sell this again, because the private equity fund is financed by investors who basically have a contract and that says after 10 years at least we get our money back. Every private equity fund has a holding period only of usually up to 10 years. So after 10 years there is the forced exit, and from this exit you can have either the reappearance on the stock market, it may again become a publicly listed company, but quite often it could become a secondary PE transaction. And that simply means the private equity fund sells the company to another private equity fund. And then another 10-year period starts. And then we could easily have a sequence. We now have tertiary PEs, companies that used to be publicly listed, that have been taken over by private equity, and that have changed the owners already 3 times Yeah, because two private equity funds exited, sold the firm to another private equity. So the ownership structure is never stable. Yeah, the ownership structure, yeah, from being a private firm or a publicly firm or a widely held or closely held firm, yeah, to being in PE hands, yeah, this is all basically changes in the ownership structure. And as an economist, yeah, I deeply believe that there is the best ownership structure for every firm. Yeah, there are advantages and disadvantages of being private, being public, yeah, having a PE as an owner or not. But this is also not static. Yeah? Very much like if you want to become a great swimmer, yeah, you should train hard, well, but then only once in your life, yeah, you need a special trainer who tells you something. Yeah? And companies maybe every 7 years, yeah, they need a kind of experience and wipe out the things. Yeah? If you believe that companies get fat, yeah, if they are too profitable, they simply employ too many people, yeah, and then there is too much bureaucracy, then maybe every 10 years you need something like cleanup. Yeah? Private equity funds that basically wipes out excess employees. Yeah? But this is not on a permanent basis. You don't need this for the rest of your lifetime. Yeah? Ownership or governance structures is something dynamic. And from time to time you simply change this in order to do whatever is the best for the corporation at that point of time. So this is how most people, I think, would see it today. Takeover activity is the search for a better governance structure. And all these ownership or governance structures are basically different ways to run a firm. And we have to continuously think about what is the best way, how to basically manage a firm. And all the models that basically, and just keep in mind that this is clearly not static. Yeah? If you basically find, this is a mid-sized car manufacturer, for him the widely held IPO one is the best. No, that's not the case, because if you have been a widely held IPO firm for 20 years, maybe you need something else. Yeah? Change as a receipt for improvement. Okay, so let's leave this as it is. And let's turn to capital structure and really back in the textbook. Yeah, we have been quite far advanced in the textbook in the M&A section, and now we go really to basics. And the basic is to learn that whether you have a lot of debt and only little equity, or only small debt and more equity, or just no debt at all. Now, all this, according to Mondigliani Miller, the famous Nobel Prize winners and the famous inventors basically of modern finance theory, they say it doesn't matter at all. Yeah, which is of course a real challenge for the people, because of course everybody in finance believes that the right financial decision is very important. And Mondigliani Miller just said, but if the markets are perfect, and the capital markets are rather perfect, it should not matter at all. And it basically forced the people to think more thoughtful about this. And the idea is very simple. Always think about this apple tree. A firm is an apple tree. And in day zero, you basically spend 800 euros in order to buy the seed, the small apple tree, and you plant it to the ground. And then at day one, it either produces 1,400 apples or it produces 900 apples. Depending on whether the economy is good or bad, whether the sunshine is good or there was enough rain. So a project or a firm is nothing else than an apple tree that sometimes produces more or less apples or dollars, whatever. And of course we want to understand how leverage affects value and risk. So given that there is risk, suppose that 10% is the risk premium that investors demand, and that the risk-free rate is 5%. What is the net present value then of this investment opportunity? By assumption, This has 50% probability. So the expected cash flow is of course 1,150. And if 10% is the risk premium and 5% is the same rate of interest, and of course the discount rate is 15%, and you would say the present value of this project is, well, this is exactly 1,000. 1,000 is the value of the apple tree. 800 is what you have to pay upfront for the apple tree, so the net present value of this investment or of that firm is 200. And so you are the firm founder. Yeah, if you think that this is really an apple tree, you buy the apple tree for 800, you plant it into the earth, then you go to the stock market and sell basically the shares of your apple tree. Yeah, the stock market will pay you 1,000, yeah, so that gives you 200 as a profit. Yeah, you invest 800, you receive 1,000 from selling the shares. That is the idea. And of course, this is the net present value is always the profit of an entrepreneur that you can basically walk home, take home, you can now fly to the Bahamas and have a nice holiday for us. Now we want to investigate how the financing structure changes this. Yeah? So this is an all-equity firm. Yeah? The present value of the all-equity cash flows is the expected cash flow discounted with the risk-free rate, with the cost of capital, and it's 1,000. Yeah? You can simply raise 1,000 by selling the equity of the firm to the stock market, and then the 200 is your profit. Yeah? And that's the idea how finance professors think about firms. Yeah? Somebody establishes the firm and sells it to the capital market. Yeah? The capital market values the firm as the discounted cash flow. Yeah? Of course, in reality, you have much more than just one cash flow. The apple tree doesn't die after 1 year, but in the simplest case, this is just a 1-year project. Yeah? And now, now we just have a second look on the risk. Yeah? We have no debt here, and if you think about, you invest, the shareholders, of course, they buy this firm for 1,000. Because in the capital market, there is competition. Yeah, where should you sell it for 800? Yeah, you can sell it for 1,000. And then plus 40 or minus 10% is the return of that stock. Yeah? If that is a stock, it will end with a value of 1,400 or 900, depending on the harvest of apples. Yeah? 1 day before the harvest, yeah, the value is either this or this. Yeah? So this is the risky returns, plus 40 or minus 10. And and the cost of capital of 15% is of course somehow related. Yeah? There was a certain size of risk, and of course, just by assumption, we did 10% risk premium, yeah? But this is the premium that is compensating for this risk. And now we want to change this and basically borrow 500 euro initially. Yeah? So we change the capital structure from all equity financed to partially debt financed. And and debt holders assume that debt is risk-free, which it is in this example because at least 900 will be available. Yeah, so they get the same rate of interest, and they are paid 525 in 1 year. Yeah, so on first hand, it looks like debt is much cheaper than equity. Yeah, you replace costly equity with 15% return by less costly debt. Yeah? And if you do so, is there any kind of value generated? Yeah? Do the shareholders benefit from this cheaper equity introduced? Yeah? So if we have the debt here that goes to 525, whatever state it is, if we have the equity that goes to, well, one in the good state, yeah, the 1,500 minus 525, yeah, this is the rest left over for equity, and the number of apples that the equity owners receive after the debt owners get these apples. And in the real economy, there were only 375 apples for the equity owners. Yeah? And the question is, what do they pay for this? If they would pay more than 500, and then you can sell then you have made a profit, because this is the all equity firm, and the all equity firm sold for 1,000. So the question is the question mark perhaps bigger or smaller than 500? And so the optimal capital structure should of course try to think about what is the biggest value of the firm. And now Modigliani Miller basically tells us that the total value of the firm should not or must not or cannot depend on the capital structure. They basically claim the value must always be the same. And therefore, the combined value of debt and equity must be 1,000. So basically, Modigliani Miller says the only answer to this question mark is 500, simply because this is the value of the leverage firm, made of debt and equity. This is the value of the all equity firm. And if Modigliani Miller are right, then 500 is the only result for equity. And they have an interesting proof of this. Basically, they say there is the law of one price. And we have to understand what this law of one price is. The intuitive idea is very simple. Suppose that this is one firm trading in the market, and then the same, there were 10 apple trees, or 2 apple trees. There are 2 apple trees, they stand side by side. They are identical. They will either have 1,400 apples or 900 apples. One is financed 50-50, debt and equity, the other is financed only with equity. Then basically, you can buy both of these. You invest in the debt. Debt, think of a bond that is traded in the bond market. You simply buy the bond, and you also buy this equity. If this would be 500, then you pay 1,000, and you get the sum of this and the sum of this. And this is of course the same then if you take the next apple tree, and you buy this all equity apple tree for 1,000, and you get the same thing. Now, what would happen if this question mark would not be 500? Then there were 2, one expensive and one cheap way to buy this 1,400 or this 900. And that's the law of one price basically means that the same things must have one price. And the same thing means 2 apple trees that are basically the same. So, tree 1, tree 2, so when you buy the whole tree, you buy the debt and the equity, and because the firm is nothing else than debt and equity, here there is no debt, so you pay only this. If they must have the same price, then of course, question mark must be 500. If it's not, what kind of activity could you do? Suppose this would be 800, and this firm is way too expensive. So that we would sell the expensive and buy the cheap. So selling the expensive is basically you sell this here in perfect capital markets, you can basically buy or sell any financial security. Yeah, just think about it. Logically, of course, we say we can easily buy shares in the market, we can buy bonds in the market. Yeah, but in perfect capital markets, just assume for a moment that you can as easy also sell these things. Yeah, so you can basically sell this firm, get 1,500 plus 800, get 1,300. Yeah, you buy the cheap one, you pay 1,000, basically net 300. And 1 year later, you basically just have, you collect the apples and you pass it over to somebody. Yeah, because you are short. Yeah, this a short position. This is a long position. The long, yeah, as a long position, you get all the apples off the tree. Yeah, either 1,500 or 900, depending on the state of the economy. With a short position, you basically hand this over to whoever you sold this to. Yeah, somebody else bought these securities from you. He is entitled to receive all the apples. Yeah, but in year one, you just hand over apples and do nothing else. Yeah, you made a 300 profit, and this is what we call an arbitrage. Profit. Yeah, so when the same things, yeah, basically this is the same as this, yeah, debt and equity, and the all equity tree all entitled you to the same cash flows. Yeah, if they should not have the same price, if you can go long and short, yeah, basically if you can buy and sell these things, you can make this profit. And so. If you think about the cash flows of the leveraged firm, the cash flows to equity, of course, they are much smaller. Yeah, cash flows have been reduced to 875 and 375. Yeah, but you can still, you're not worse off because you're still can raise a total of 1,000 by issuing both debt and debit equity. And as a consequence of multiplying that's right, you are indifferent between the two choices. If you are the entrepreneur, you basically have invested the 800 euro and have planted the apple tree, and now you are going to sell this. The argument says you get the same amount of money, 200 net present value, irrespective of whether you do it with debt and equity. And we go this through. So if this equity, debit equity, sells for 500, and you just look at the returns, it turns into 875 or 375. If you just translate this into interest rates, this means 75 or minus 25. This is much bigger than the plus 40 or minus 10 that we had before. You immediately see risk is increasing, and that's what we call the leverage effect. We have now levered equity, levered by the debt, and this levered equity becomes more expensive. Now, if you calculate the average return, we have those with 50% probability, 50% probability of receiving 40 or 10, gives you right in the middle, and this is 15%. The mean value between plus 25 and minus 75 is 25. So the expected return of the equity increases from 15 to 25%. Although the price does not change. The value of the firm is still 1,000. So what we see here is not any value impact, but given. The big thing is value additivity, if these two values add to 1,000, then we see that the average return on equity goes up, that the risk of the equity also goes up. And that's what we call the leverage effect. If you lever your equity with equity, if you lever your equity with debt, then your equity will become more risky, or on average more profitable. And many people think that they can make more money. 25% sounds more interesting, but it's just a compensation for the risk. We will soon. So it's a. If you think this is too much, this equity is too attractive, why shouldn't I charge more money for this? If I sell this for 500, then people will make 25%. Why not increase this to 500 and plus something? And then this is still a little bit higher than 50%. Why not create value and sell the whole firm at a higher price than 1,000? And actually, this kind of the law of one price prevents this. In the end, if the same things have the same price in the capital markets, if arbitrage can basically prevent this kind of wage value differences. I think you don't have to understand anything about arbitrage. Just imagine that the tree 1 and tree 2 are both traded in the capital market. If you want to purchase tree 1, that's very easy. You just buy the stock of tree 1. If you want to buy tree, if you want to buy this tree, you basically all you have to do is to buy the equity plus the bond. And you get the same kind of harvest, and the same harvest should have the same value. And if you, and then basically you agree it can be only 500. If you just accept this, then you will see that as a consequence, the risk is increasing and the expected return is increasing. The equity of the leverage firm is much more risky than the equity of this. Basically, the apple tree has risk, and in all equity firm basically has exactly that risk. But if you instead think about a leverage firm, then the leverage means that the risk is increasing. So you have apple tree risk plus leverage risk if you hold this leverage equity. And you see it in the increased return on equity. So Modigliani Miller basically says that if the same things have the same price, then, and of course they say this is the capital market, then the total value of a firm is equal to the market value of the total cash flows by its assets and cannot be affected by the capital structure. This tree and this tree basically trading in the form of stocks and bonds must be the same. If you just believe that this arbitrage proof works and then just believe that the proof is correct, and there should have one price, then we can follow from this logically that the leverage recap, which we actually proposed for before as an anti-takeover device, this actually does not work at all. It doesn't bring the share price up. Let's try this out. The leverage recap is nothing else than a change. Maybe you start here without debt, and then you end with debt. And we ask ourselves, will this bring the value of the equity up? Will this make the firm owner richer? So initially, an all equity firm, flat 50 million shares, $4 per share, so 200 million is the market cap of that company. And now it plans to increase leverage by 80, and it will use the debt in order to repurchase 20 million of shares at the current share price. And this transaction has basically two steps: sell the debt to get the 80 million, and then use this in order to repay the debt. How would it look like? Initially, you have assets worth 200 because the equity is worth 200. On the next stage, you still have the apple tree, the assets, and the equity is worth 100. Plus, you have raised cash. Yeah? There is 80 of cash in your balance sheet, and there is this equity, this debt on the balance sheet. Yeah? The shares outstanding are 50 million, and there is still 50 million. Yeah? And the value per share is $4. Yeah? And why should it be different here? It is still $4. Yeah? The shareholders actually realize that they still own the existing assets. They also now own this 80 in cash, but they also have 80 in debt. So the share price will not reflect that. Yeah, and then afterwards, the cash is gone. 80 shares are repurchased, so from 200 goes down to 120. And so there are only 30 million shares outstanding right now, down from 50. And the value of the share is still 4. Yeah, simply because 120 million times 3, sorry, 30 million shares outstanding times the share price of 4 gives you this market value of equity, and together with this debt, this is the value of the equity. And this word here is the most important. Yeah? The value of the firm is unchanged. Yeah? The value of the firm used to be 200 and is still 200. Yeah? So if you agree in the assumptions of this example, then you should also agree that changing the leverage doesn't matter at all. Also, if you go from here to here, so the leverage firm basically goes to pay back its debt by issuing new shares. It sells 20 million new shares to the market, it returns the debt to the bank, and it migrates from here to here. It's also the same thing, it's just the other way around. Changing the leverage, either upwards or downwards, doesn't change the fact that there is an apple tree worth 200, and basically it stays at 200 and nothing changes. So let's think, this is a kind of it's a super simple model, but it still has some assumptions there that we need to understand. If the assumptions of this model are correct, then we see that, of course, increase in the leverage cannot make you better off or richer. It still applies that this equity here is more risky, has a higher return on equity, a higher expected return, but clearly in this example there was no value change. And the real assumption is basically that the existing assets, 200 here, 200 here, which of course always, but even when we do balance sheets, we always think about market values. This is the tree, and the tree basically is producing cash flows or apples, whatever you call it. And the market value of the tree is not changing at all. So you will harvest the same amount of apples, whether you have equity or debt and equity. This is the assumption number one. The investments of the firm is not affected. And in reality, that may be a wrong assumption. In reality, when we value a firm, we say the value of the assets is the value of all assets, also of future assets, future investment opportunities. And we could say this 200 is the current machines plus anything that we will invent in the future. But if we have too much debt, we may not be able to exploit these future investment opportunities. Yeah? These 200 includes basically the realization of future projects, and that may be impossible. Yeah? So the core assumption number one is the value of the assets, or the discounted cash flow of the assets is unchanged, and they will produce as many apples or cash flows. And the second assumption is, of course, you can sell and buy securities at current market value. Yeah? The current market value is $4 per share, and you can simply buy and sell shares at these $4. Yeah? That is what we call a perfect capital market. Yeah? It could be that just by the firm announces, I'm going to repurchase shares. Maybe this is a good signal for something, yeah? And the stock market value goes down to $5, just as a result of the signal. Yeah? Suppose Elon Musk is announcing to buy back 10% of Tesla shares. Yeah? What would be the reaction of the Tesla share? It would immediately shoot up. Yeah? Because Elon Musk must be extremely optimistic about Tesla shares, otherwise he would not purchase them. Yeah? So the announcement of a share repurchase may have signaling effects, and may bring the share price up. Yeah? Here we basically say the share price is 4 and it stays 4, yeah, if you repurchase shares or not. Yeah? And therefore there was nothing then such that asymmetric information, such that a repurchase could signal anything, and that signal can bring the share price up and down. Yeah, so here in this example, we simply say we need to repurchase 20 million shares in order to and we spend 80 million on this, and then the asset decreased by 80 million. I think we did this. This is just a repetition of what we did. Yeah, and from this simple example, we can say the value of equity and debt of a levered firm is identical to the value of the unlevered equity. You have this tree number 2. Yeah? This is on the left-hand side. Yeah, this is this. This is equal to the unlevered firm. We have the value of equity without leverage. So this is again equal to the assets. Yeah, the value of the apple tree. Yeah, because this stock is nothing else than the right to receive the apples from the apple. Yeah, and we can basically then reformulate this in returns, and we realize that the return of the unlevered firm is this. This is what we already saw in the back calculation. It is just without without any taxes. Yeah, we are still here in a tax-free world. With taxes, of course, all these does not hold. By the way, if you derive this formula from this formula, it's simple mathematics. I mean, it's there for me. It's just that you have to calculate, when U is going up, then you have U0, U1, and then calculate the change of the U, and then basically express it as a change of E, and then change of D. This is easy to understand. So, and when we just solve for the return on equity, then we realize that the return on equity is the unlevered firm plus something else. This is positive, and the more debt you have, the higher the return on equity will be. So if you go back to this example, we had 50% and 25%. There was, of course, a formula behind this. And basically they all come from this formula. Maybe we try this out. Hopefully it works. So we had RE, 25%. As RU, this was 15. No. Yes, it was 15. Unlevered equity is 15%. Plus D over E times RU minus RD, let's say. So D over E is 500 over 500. And then RU is 15%, RD is 5%. So we have 15% plus 1 times 5%. And it works. Yeah, so, yeah, this is just the general formula, yeah, for what we found in the special case some slides ago. Yeah, so, so we learn when multi-dimensional implies, when we have perfect capital markets, when we have nothing that disturbs, so to speak, yeah, and we have apple tree 1 is the value, has the same value in the capital market than apple tree 3, apple tree number 2, then we can calculate the expected return. This is the expected return of levered equity from the expected return on the unlevered equity. Yeah? So in order to see what this 50% equity returns on average, yeah, we start with the return of this 100% equity finance stream and add something. Yeah? And the equity will have more return, yeah? And the amount of return depends, of course, on the debt to equity structure and on basically the difference what the unlevered firm earns in excess to RD. Yeah? Just a little thought experiment. Suppose we live in a world where the people are risk neutral. Yeah? In our world, we assume that the capital market investors are risk averse and they require a higher return for taking risk. Yeah? In the world that we have here in Longos, basically you can make 5% by investing into government bonds, and you can make 15% by investing into this trade, yeah, without leverage. Yeah? So we assume that people are risk averse. If the people would be risk neutral, then this tree is as good as a government bond. Or the expected return must not be bigger. In a risk neutral world, this difference is 0. Yeah? Because people just don't care. Yeah? They also from the apple tree, they just expect 5%. Yeah? And then of course you can add whatever you like. You multiply with 0%. In a risk-free world, everything has a return that is, in a risk-free world, RU is 5%, RD is 5%, yeah, here again is 5%, yeah, so levered equity will also be 5% plus 0. Yeah, so without risk aversion, people don't care about risk, people don't price risk, and all the expected returns will be the same. It's all the risk-free rate. Yeah? But if we have risk, if this 100% equity finance tree makes 15%, so 10% more, yeah, then we can follow. And if we add more risk to this, yeah, by adding leverage, yeah, then this leveraged equity tree must have 25%. Yeah, so the price of the risk is basically given by this 10% extra on tree number 1. Yeah, because people are risk averse, they want 15%. That's our assumption for the tree. Yeah, they demand 10% more. Yeah, and given that we already know the premium for risk, yeah, if we now then double the risk basically, yeah, in this example, we implicitly double the risk by putting more debt on it, yeah, and for twice the risk premium is also doubled from 10% to 20%. Yeah, so we don't know where this risk premium comes from. Yeah, just by assumption we say this is 10%. Yeah, but once we have this as an assumption, yeah, then debt equity choices just increase the risk in a linear way, and we add to the risk premium in this way. So, we interpret this as the cost of levered equity is the cost of unlevered equity plus something on top. And how much on top depends on how much leverage you add, measured by D over E, and of course by the risk premium of the unlevered firm. Yeah, the expected return on the levered firm is higher. So when you sell this firm here, the value of the equity of the levered firm is 1/2 times 875. That's 875 divided by discounted for one period, with 25% plus the other half is 575 divided by or discounted with 25%. Once we know the cost of capital, and you can believe me, this is correct. This is 500. If we use the same way discount. Modigliani-Miller basically says this must be 500. Modigliani-Miller also tells us that the expected return comes from this thing, and we interpret it as the cost of capital. So if you buy these two cash flows and you value this as a capital market, you will apply this as a discount rate. So this is basically what you expect to earn, or what you require to return, or what you use as a cost of capital. Something, same different words for the same thing. Now, if you calculate it through, you bring equity from 1,000 back to 100 and increase appropriately, then you see that the return on equity is going up and up and up. The return on debt, as long as debt is risk-free, we still stay here. At some point of time, of course, the debt becomes endangered by bankruptcy. And then basically you have an increase also in the cost of debt. But let's leave out this last thing. And this is how it then looks like. The cost of capital for a long time stayed at 5%. Until in the bad state of nature there were not enough apples for the debt holders, and then it goes up. The cost of equity goes up according to the formula. And this yellow one, that is the important one. That is the overall cost of the firm that stays constant. So under the Modigliani-Miller world, the unlevered cost of capital stays the same. And if you just think, this is basically the formula that we used in order to value Continental. The only difference is this 1 minus t for the tax rate. Whenever we do firm valuation, just assume the tax rate should be 0. If we do a DCF analysis, then we basically say, let's look, when we value a firm, we could, we basically look at the cash flows of an unlevered firm. We look at the cash flows before interest and other costs. So basically we look at these cash flows. And we discount them with a discount rate that is coming from this here. Basically based on the assumption that there is only one cost of capital. So without taxes, this discount rate that we use, the WACC that we use in our DCF analysis is basically coming from this formula. So the way how investment bankers value firms, if you leave aside the tax effect, is basically completely consistent with Modigliani-Miller. Yeah? And as long as the tax rate is 0, the irrelevance will also show up. Yeah? If you value Continental with this DCF method, yeah, like you did in the exercise, yeah? And if you set the tax rate to be 0, yeah, then you can change the leverage how you like. Yeah? It will always be the same. Yeah? Because you discount, yeah? You basically take the unleveraged cash flows, you discount them with one rate, yeah? And if you change the equity, nothing will change. Of course, as long as you calculate the expected cost of equity the correct way. Yeah, this is the formula. Yeah, this formula basically tells you that higher leverage comes with a higher expected cost of capital. Yeah, so of course it would be simply wrong, basically to assume a high leverage, but at the same time a non-consistent return on equity here. Yeah, so as long as you put the right numbers in, yeah, that are consistent with theory, yeah, then you will not find any impact on leverage. Yeah? Conti will have the same value for every capital structure. Yeah? And by the way, in the assignment over the weekend, of course, we didn't use this formula. Yeah? We used the cap M. Yeah? And the cap M is based on the beta. And you may say, yeah, but the cap M is something completely different. Yeah? Is it still consistent with it? Yeah, and the miracle is it is. Yeah? If you change the equity structure, we know that the beta will always change, or also change. If the beta changes, yeah, then basically also the cap M says that the cost of equity will increase. It's just another formula for the cost of equity. And if you go to advanced textbook of finance, yeah, then you will learn that this is fully consistent. Yeah, so this cap M and Modigliani Villa basically both come to the conclusion, yeah, that without taxes, without other things that may impact, there is no effect of capital structure choice. Great. Yeah, and we can basically say the same thing with beta factors. Is there something? Okay. At this point of time in the textbook, actually, the concept of beta has not been really introduced. And yeah, but let's simply assume that beta is the risk measure, yeah, and that you measured beta for an equity, for example, with a regression, and you measure beta of the debt, and then you can show that under Modigliani Villa, yeah, not only the returns but also the beta basically follow the same formula. So the unlevered tree of the unlevered equity beta is simply the mixture of equity beta and debt beta. And allow me not to derive the formulas here. It's not that difficult, but still need some lines of derivation, and the textbook doesn't do it. Yeah? The formulas are exactly the same. Yeah? So whatever you can say for the return, yeah, in terms of RE or RU, you can also rewrite in terms of risk. Yeah? Everything applies in an absolutely parallel way, yeah, to the risk as expressed by beta. Yeah, so if beta E is the market risk measure for a firm, yeah, then it basically depends on the beta of the apple tree, yeah, of the assets, plus an extra add-on that depends on the leverage. Yeah? The more leverage, the more risky the equity will become, and you will show it in a higher beta. Yeah? And if you would have both apple trees traded in the capital market, you do a regression in order to find the empirical beta, yeah, then you hopefully would expect, that this formula explains the differences. Yeah? Tree number 1 would have a higher beta than tree number 2. Yeah, and the difference of the betas will be explained precisely by this formula. Yeah, and now we want to introduce a text deduction, but I think it's now also time for another 5-minute break. We go, yeah, until 4 o'clock. Yeah. So we have 1.25 hours left. Yeah, so let's have a 10-minute break right now, and then look how all this change with text.